In this video lesson, we will consider fiscal policy, how exactly it affects national economy. Fiscal policy is implemented by the government, and it attempts to control, to change aggregate demand by affecting the balance between government expenditure, which represents an injection into the circular flow of income, and taxation, which represents a withdrawal. If you recall the circular flow diagram, which we've covered in a lecture on national output, we've covered three types of injections and withdrawals. We've learned that injections are things which increase the size of the economy, the amount of income and number of goods fluctuating throughout the economy, while withdrawals or leakages will reduce the scale of the economy. And government expenditure represents an injection. It helps to boost the economy. While taxes represents a leakage, they reduce the amount of national income. So generally, taxes and government expenditure, government spending, are two main tools of fiscal policy. How exactly do they work? Taxes will affect disposable income of households. For example, if we increase taxes, this will lead to lower disposable income in our pocket. Disposable income goes down, which will reduce consumption level. We have less money to spend. Since consumption is one of the components of aggregate demand, recall our famous formula. Consumption drops, and as a result, aggregate demand will drop as well. It will shift aggregate demand closer to the origin. This is how exactly taxes will affect aggregate demand. Increase in taxes represents a contractionary policy, and the other way around. If taxes go down, this will increase disposable income, increase consumption, and stimulate aggregate demand. On another hand, government expenditure can also be used to change aggregate demand because this is a component of aggregate demand. For example, we might want to reduce government expenditure, right? This will lead to a reduction in one of the components of aggregate demand, and the effect is very simple. It leads to low aggregate demand straight away. So we can use this in order to manipulate aggregate demand. We can use these two tools. There are two other concepts which you need to know about fiscal policy: budget deficits and budget surpluses. As I mentioned previously, we are trying to affect the balance between amount we spend as a government expenditure, and the amount we collect in taxes. Budget deficit will be a situation when government expenditure, spending, exceeds the revenue from taxation. In other words, government spends more money than it collects. So government expenditure exceeds revenue from taxes. This is a form of expansionary policy. It will lead to higher output because when we spend a lot of money, it leads to higher aggregate demand. Aggregate demand goes up when we run a budget deficit. On another hand, budget surplus is the opposite situation. It's a situation when government expenditure is lower than amount we collect in taxes. In other words, government expenditure is relatively low while taxes are relatively high. When government expenditure is low, it will lead to lower aggregate demand. When taxes are high, it will lead to lower disposable income and therefore lower consumption level. This will also lead to lower aggregate demand, and therefore this will lead to lower output. So budget deficit, it's an expansionary policy. Running a deficit implies that we are expanding, expansionary policy. We are expanding our output, and therefore we also increase employment level, national income level, and so on. However, budget surplus is a form of contractionary policy. Contractionary policy. Sometimes it's called fiscal consolidation or austerity measures. We try to repay the previous deficits which we've accumulated at the previous years. And the thing is, if this is expansionary and this is contractionary, if it will lead to a certain amount of positive events like higher output, higher employment, why don't we run deficits all the time? This is because we can't. Because it is very popular with governments to increase government expenditure, to reduce taxes, and many governments do run budget deficits. The problem is deficits will need to finance by borrowing, and we cannot borrow forever. Eventually, we will need to repay our debt. At an individual level, sometimes you can spend more than you earn. For example, when you are a student, you earn very little money, but you need to maintain certain lifestyle. You need to pay probably for your student tuition fees, you need to pay your rent, you need to buy food, and probably you are not earning enough to cover all that. Therefore, you are running a debt, which you will repay later in the future when you will graduate and start working, when your income will increase and you will be able to repay your previous debts. So you do accumulate debt at a personal level, and the same is true with countries. If we do spend more than we earn in certain periods, we accumulate national debt, which is simply the total amount of government borrowing which you have accumulated over the years. We cannot run a debt forever at a personal level and as a country, and we need to repay it eventually. That is why we will need sometimes to run a budget surplus. We will need to implement contractionary policy in order to keep the national debt under control. Let's have a look at a few empirical trends. Let's check how government deficits or surpluses and national debt vary over time between different countries. This table shows a few pieces of data. The first column shows time period from 1995 to 2007, so before the global financial crisis, and the second column illustrates how it changed immediately after this. And what we can see from this table is that majority of developed countries do run budget deficits. So we can see here that before 2007, in the last decade, there were only 2 countries who managed to balance their deficit or run a small surplus. However, even these countries significantly expanded their deficit immediately after the global financial crisis. Global financial crisis led to global recession in majority of countries, and in order to support their countries, to reduce the depths of this recession, to reduce the reduction in national income, to support population, people, businesses who lost their jobs, who lost their sources of income, government did run a deficit. They increased their government expenditure to support the economy and reduced taxes as well, which led to substantial increase in deficits. For example, our country, which used to run a deficit just under 2% of GDP, expanded it to nearly 9%. And this is true for majority of other countries. For example, you can see that Greece doubled their deficit, and even Ireland, who managed to run a small surplus in the previous decade, actually had to increase their deficit dramatically. Their deficit was the largest among these countries. In Europe, the accepted limit is that deficit should not exceed 3% of GDP. And as you can see here, that immediately after the global financial crisis, majority of countries didn't satisfy this criteria. What is also important that both deficit and national debt tend to become larger over time, because the more deficit we run, the higher our national debt will become. Because we accumulate deficits, we overspend in 1 year, in the second year, in the third year, and gradually the debt will accumulate. For example, in our country, immediately in 3 years after the financial crisis, our national debt has increased from about 43% of GDP to over 70%. And there is one country which reached just incredibly high national debt level, Japan. After the financial crisis, their debt reached 212% of GDP. So the whole 2 years of the whole country working and not consuming anything at all would be required to repay their national debt, 2 times the national GDP. Second type of the demand-side policy is monetary policy. It is implemented by the central bank, so fiscal policy is controlled by the government, while monetary policy is controlled by the central bank. In the UK, it's Bank of England, specifically Monetary Policy Committee of the Bank of England, which meets every couple of months and makes monetary policy decisions. While in America, it's called Federal Reserve System. It's not just one bank, it's a system of Federal Reserve banks. And monetary policy involves the central bank intervening in money markets. The actual mechanics is rather complex, but what you need to know is that there are 2 main tools of monetary policy which the central bank can use. First of all, the central bank can directly change money supply. This is what we frequently call printing money. Also, in reality, there is no printing involved. Everything nowadays is digital. For example, if the central bank increases money supply and circulation, more money implies that we are able to provide short-term boost to the economy. I'll later explain how exactly it works. It can lead to short-term increase in output, unfortunately at the expense of higher long-run inflation. Again, we'll come back to the differences between short-run and long-run effect in a minute. Generally, the mechanics of changing in money supply is rather complex, and usually it involves changes to statutory minimum reserve requirements, which commercial banks will need to obey, and also open market operations, buying and selling bonds. However, for this module, we need to think in simpler terms, just changes in money supply, high money supply or lower money supply. Apart from this, central bank can affect the interest rate, and these changes will have the following transmission mechanism. A reduction in interest rate will encourage more borrowing. Interest rate is cheaper, which means that your cost of borrowing is low, which means that you can now borrow more, which will encourage investment, expenditure in the economy. Companies can now afford to borrow more money for expansion purposes, to acquire additional capital, additional equipment, production lines, and so on. Companies can invest more, so they borrow more for investment purposes. Apart from this, lower interest rates will encourage higher consumption because households also borrow quite a lot of money to finance their everyday expenditure. For example, you can finance your wedding by getting a loan, or you can get a car loan to get a new car, obviously, or especially relevant for the UK, when you buy a house, you need to get a mortgage. Mortgage is a special type of loan which you are getting when you're buying a property. And cheaper interest rates, again, will encourage higher borrowing because now you can afford to borrow more. It's cheaper. Therefore, when both components of aggregate demand, consumption and investment, will increase, this will, of course, lead to an increase in aggregate demand overall. Let's recall again our equation: consumption plus investment plus government expenditure plus net exports. Lower interest rates will increase consumption and investment, and therefore this will increase aggregate demand. It will shift aggregate demand curve outwards. It will be located now higher. We are moving along the same aggregate supply curve towards a higher equilibrium level, which means that our national output will now increase. However, this will be achieved at the cost of high inflation. National income will go up, however, prices will now be higher as well. And the other way around, an increase in interest rate will make borrowing more expensive, which will reduce these two components of aggregate demand, consumption and investment, and therefore will shift aggregate demand curve closer to the origin. It will become lower, which will contract national output, however, will also help us to achieve lower inflation. Changes in interest rates is a very frequently used instrument. What you also might need to know is that it is impossible to adjust or to control both money supply and interest rates at the same time. Central bank can usually target one of these tools. Let's have a look at this diagram. This graph shows what is happening in the money market. We have money demand, here downward sloping line, and money supply, upward sloping money supply. Like in any demand and supply diagram, we have quantity located along horizontal axis. In this case, it's quantity of money, money stock in circulation, and we have a price of money located along vertical axis, price of money, which is interest rate. Interest rate is the actual price of money. This is how much we need to pay if we want to borrow some money, for example. Let's imagine that we are originally located at some equilibrium point E1, which implies that we have certain amount of money stock in circulation and we have certain interest rate in our economy. Let's say 0.1%. This is what we have at the moment, and we have certain amount of money. Let's imagine that we want to reduce money supply. What will happen as a result? Our economy, our money market will move to a new equilibrium point E2, right? Money stock is now lower. Now money stock is equal to Q2, which will lead to an increase in interest rate. For example, up to, let's say, 0.5%. It's now more expensive to borrow. Why we cannot target both at the same time? We adjust money supply. This is what we want to control. We want to reduce money stock. We withdraw some amount of money from circulation, and as a result, price of money will adjust on its own. Or we can target a certain amount of interest. For example, we want to achieve certain interest rate. We want it to be now set at this particular level. And in order to achieve this, we will need to adjust money stock. We will need to reduce money stock. We'll need to withdraw some amount of money from circulation. Normally, this is exactly how it works. Normally, a certain change in interest rate is announced first, and then central bank implements open market operations in order to reach this target interest rate. Money supply is adjusted accordingly. The problem with this policy, why it's sometimes difficult to target interest rate, is instability of money demand. And with this diagram, we assume that money demand remains stable, that we will move along the same money demand curve. We want to move to this point, which means that we simply need to shift money supply by a certain amount. However, if money demand curve shifts unexpectedly, and this can indeed happen, this can take us to a totally new equilibrium point. For example, if money demand shifts upwards for whatever reasons, instead of being located at point E2 as we've wanted, as we've planned, we might actually end up in undesirable point E3 when our interest rate is significantly higher, more than necessary, or money demand can actually decline again unexpectedly. So it's not as easy to implement monetary policy. But here in the UK, we have highly experienced Bank of England with amazing professionals, and they know what they are doing. Actually, if you will go to the Banks of England website, you will see these main characteristics of monetary policy straight away on the front page. For example, this is the current interest rate set by the Bank of England, and it actually might be changed literally in few days' time, because this is when the Monetary Policy Committee will meet next time. And the current forecasts are that it can actually increase. Bank of England might increase it in the future. This is the current amount of quantitative easing program, how much liquidity central bank has provided, and this is the current inflation rate. It's just over 3%, while the target inflation rate is 2%. We've been running expansionary policy for the last decade, actually since the financial crisis of 2007, more than 10 years. And we've supported our economy. We kept boosting it. We kept shifting aggregate demand curve. And as we know, when aggregate demand curve keeps increasing, keeps going up, it will eventually lead to acceleration of inflation. And this is what we are suffering from at the moment. Our current inflation is significantly above the target, which means that we might need to implement contractionary policy now. And this is what is likely to happen in the nearest future. The central bank is likely to increase interest rates in order to discourage the economy from overheating. The final thing which we need to know about monetary policy is the general consensus among macroeconomists about the long-run neutrality of money. What does it mean? In macroeconomics, there are different schools of economic thought. In other words, groups of scholars, academics, professionals who have different opinions on how exactly economy operates and what specific tools of economic policy we should use to achieve macroeconomic policy objectives. And in the reading which I recommend for this particular week, I refer to certain pages on your textbook where you can read more about this, what schools exist and what are the nature of disagreements between them. However, different schools do agree on this particular thing, on the long-run neutrality of money. It means that increases in money supply, expansionary monetary policy, will only have a short-term effect. It will help us to boost output temporarily in a short-term period. However, in the long run, it will not have effect on any real variables. It will not help us to keep output at permanently high level in the long run. There will be no effect on other real variables as well. It will not boost national income, national output, employment level, real investment level, real consumption level, and so on. Any attempts by the central bank to support the economy will only work in the short term. In the long run, the only effect will be increasing inflation. And this is exactly what we are experiencing now. Monetary policy was used for a decade to support the economy, and now we are moving towards the longer period, longer run, where it stops working, it's not supporting the output anymore. However, we are now experiencing increasing prices. So that is why, in order to keep inflation under control, it is important to control the supply of money. This is what we've covered in the previous lecture on inflation. where I've shown you the formula where inflation rate depends on amount of excess money supply, which exceeds the current rate of economic growth. The current inflation target for majority of European countries is 2%, and for the UK it is as well, but as I've shown you, at the moment it's higher than 3%. That is why we can expect tightening of monetary policy in the nearest future.